My name is Jake, welcome to the channel, and today's video we're going to do a review my pie video where I review subscriber portfolios. The reason why I like this series so much is it's more of a casual conversation. I don't take a lot of time and edit these videos. It's more focused on, just you and I having a conversation about different topics around dividend investing. And something that I learned from these videos is everyone's in a unique situation. Everybody's got their own thing going on in their life. The majority of people who are following my channel, the majority of you out there have a similar goal where you're looking to one day live off of your dividend portfolio or transfer or transition from relying on your active income from your day job to then one day living off of your dividend portfolio. And if you know my story, that's exactly what I did. I retired from my 9-to-5 job at the age of 37 here 3 years ago in 2023. And yeah, I also make YouTube videos. I write options on my dividend portfolio. And yeah, that's a little bit about me. But yeah, there's not so much, these review my pie videos, I like to take more of a casual approach to these. Just if you and I were sitting down in a room, we were having a conversation, these are the things that I would generally say to you. In today's review my pie, we're going to take a look at a question from a 56-year-old here in the United States. Then we're going to take a look at 3 portfolios. The first from a 33-year-old here in the US, the second an 18-year-old from the US, and then the third a 29-year-old here in the US. As always, everybody, the timestamps will be in the description below, as well as the portfolio links in the description. And as always, everybody, please don't take what I'm saying as financial advice. This is just merely for your entertainment. And as always, everybody, I don't look or review the portfolios in advance. As I'm recording these, I'm reading them for the first time. And if you do want to book time with me, you're able to do that. I offer this once a week where you can book an hour with me. We can talk about your dividend portfolio or anything that you would like to talk about regarding, your investment strategy. The reason why I offer this is when I look back on my own experience, I always wish that there was somebody there that I could have bounced ideas off of. And so I don't tell you what to buy and sell. I just offer my, my opinions and thoughts on, given your situation. I try to drill into what you're struggling with and see if I can help you in any way that I can. I offer this once a week, and I'm going to be doing this here for the rest of December. And then in January, I'm going to be taking a month off because we're going to be driving back down to Austin. But if you're interested in that, you can check it out, and I'd be very excited to meet you. When I make these review my pie videos, I try to make it as applicable as I can to a wider audience. Now, I'm addressing specific situations, but I try to apply it to as many people and, scenarios as I possibly can. When you go on YouTube and you search different topics about investing or dividend investing, you're going to get a little bit of everything. There's good information, there's bad information. It's all subjective, in my opinion. If something's good or bad, there's many paths that can lead to success. But something that I've noticed is that there's a lot of content on YouTube that can really run you into some troubles if you're not careful. I remember at the beginning of this year, in a lot of my, on my videos in the comments, I would see people write, "Hey, Jake, just invest everything into Misty and retire early. That's all you need is just one ETF Misty." And I was wondering if these were like real comments or if they're like, I just was like, why are all these comments all of a sudden popping up? And, if you've been on YouTube for a while, you probably saw these videos or these comments about retire early on Misty, this covered call ETF that tracks MicroStrategy or whatever, this Bitcoin company. And, when you follow the finance gurus on YouTube that have a high-pitched voice, who told you to put all your money in Misty so you could retire early, off of $50,000, sometimes those strategies work, and well, most of the time they don't. And when they don't work, I guess it could look a little like this.
No más.
Gosh. Oh man, I love it when he like sticks out his tongue and he's like, ah. It's like all those finance gurus that made triple, selling you a course or off the ad revenue or whatever they made here on YouTube than actually making in the stock market. You gotta love it. Gotta love it. All right, okay, so let's take a look at this. Let's take a look at a question here from Charlie. He writes, "Hi, Jake. A bit about me. I'm 56 and planning a major life change. I'm selling my assets, about $700,000, and moving to Vietnam, where I can live comfortably for much less. Before I leave the US, I'm setting up a legacy trust for the family I love dearly, but they aren't financially savvy. My plan is straightforward: put everything into an LLC controlled by the trust, invest it all in the market, and let it grow. When I'm gone, the trust will take over the LLC, managing and never selling the principal holdings. The trustee is instructed to automatically reinvest 50% of the annual dividends while using the other 50% to cover trust fees and provide a yearly distribution to my heirs for generations. I know the starting amount isn't huge, but I'm hoping compounding will build something meaningful over a generation or two. To keep things simple, I don't think growth funds will work because there won't be anyone truly managing it. I'm looking for a plain dividend-focused set it and forget it allocation that's easy for the trustee to maintain distributions for my heirs. Can you help design a bulletproof portfolio that can possibly stand the test of time? Thanks for the inspiration and all the great content. P.S. If you think this would be a helpful video, I'd love to see your take. If it's too deep for a video, I'm happy to book a meeting with you to discuss. That may be best. Anyway, so Charlie, well, first off, I'm super excited for you to go to Vietnam. It sounds like you're flipping the switch. You're like, you know what? I made it. I worked. I did my time in the US. And now you're going to set sail into the sunset and move off to Vietnam. I thought about that many times, going to, Portugal or Panama. I was seriously considering going to Panama during the pandemic. I had countless conversations with my wife. My dad and I, we even went down and scoped it out. And then this year, aka this year, this year in January, we did a lot this year. We went to Panama and checked it out. But yeah, so I guess, there's not a lot of people in your situation, so this isn't going to be applicable to everyone. What I would recommend is, when you think about, really when I look at your situation, there's a lot of things that you may want to, account for. Maybe in future generations, your kids stop having kids, or, your bloodline stops, right? Like, have a clause in there that may, take into consideration, well, should my kids no longer have kids, what would happen then? Does the amount get, donated to a charity of your choice? Certain things like that you want to kind of consider. I'm not an expert on this, but just thinking about the what ifs, the unknowns are probably a good idea. But when it comes to this possibly stand the test of time. Now, I don't want to, it's kind of putting a lot on my shoulders because I don't know what's going to stand the test of time. I don't have a crystal ball. But what I would do is, if I was in a similar situation, I probably would not invest into any individual stocks. I would have 2 or 3 ETFs, and that's it. So if I were to put myself in your shoes, and if I was in that situation, I would kind of think about 2 different possibilities. There's 2 situations that I would consider. The first, option that I would consider is I would put all the money in one ETF, in the Vanguard Total World ETF, VT. This ETF tracks every publicly traded company. It is market cap weighted, so it's the survival of the fittest. If a company is doing well, they represent a higher percentage in that index. If a company goes bankrupt or falls out, they are automatically taken out of that index. So it's self-cleansing. And so for me, like, market cap weighted ETFs are the only way to go if you wanted to stand the test of time. So I would only focus on ETFs that are market cap weighted. And so that would be the first option that I personally would consider, is I would buy every publicly traded company in the world and set it and forget it. Now, this ETF is not a dividend-focused ETF, but it does pay off a distribution. And so over time, the portfolio will grow and grow and compound. And so if you wanted to stand the test of time, that's definitely an option that I would consider. But once again, it's not a dividend ETF. It does pay a dividend. And so, Maybe you even have a clause in there that you sell 1% in addition to the portfolio, and you distribute that to your heirs, the fees, the trustee, all that good stuff, the fees and stuff. So there's many things that you can consider. In my opinion, that is probably the most likely. I don't have a crystal ball, but if I were to bet money on it, that would probably be the safest approach to go. The other alternative would be I would invest into either VTI or VT or VOO, total market index fund, right? And 30 or 40% into something like SCHD, VYM, DGRO, VIG, something like that that's been around for a while, and just, have it set up that way. But I would have a clause in the trust that says if the ETF were to be suspended or no longer exist, that all of the funds be transferred to a like-kind ETF. So that the trustee doesn't have to think or do anything. It's all clear that should that ETF cease to exist, we don't know what's going to happen in the future, right? Most companies over the course of time end up going bankrupt. I don't know what's going to happen to Schwab, Vanguard, or any of these other companies. So having a clause in there that says, hey, should this ETF cease to exist, that the trustee will take the proceeds of whatever's in there and reallocate it to a like-kind ETF. And that's what I would do. I would keep it sweet and simple and not overthink it. Well, you kind of want to overthink it in terms of the what ifs, but in terms of the investment, I would keep it pretty simple, pretty straightforward, no individual stocks, and just explain it to your heirs that this is how you have it set up, and enjoy the rest of your retirement, and understand that once your time is up and once you pass, that your heirs are set up. So, and in my opinion, what I'm sharing with you is based off of this statement, that's something that will stand the test of time. So Charlie, thank you so much for the question. I hope that helps, and hopefully it gives you a little bit of insight in how I look at this, and hopefully it'll give you a few things to consider. Thanks for sending over the question. The first portfolio is here from Dale. He writes, hello, I hope you and your missus are doing well and making progress towards your goals. I'm Dale. I'm 33 years old. I wanted to pick your thoughts about my M1 Pi. I stash my spare cash in there for retirement, plus I get a pension through my job. Appreciate taking your time to look at this. So, Dale, I think when it comes to your portfolio like this, it's really, really important to first understand that I'm only able to share thoughts and opinions based off of someone's time horizon. Depending on your time horizon, my comments will greatly vary. So if you're 33 years old and you want to retire at 45, it's very different than if I were to, if you were to retire at 65, right? The type of investments that you're invested in, where you're invested your money, right? Whether it be a retirement account, a taxable account, all of these things matter. So when you're thinking about your own situation, it's so important to understand and ask the question, what is my investment time horizon? What am I investing for? Versus, hey, is this a good stock, right? Is this a good investment? Because every investment, it really, whether it's good or bad or anything in between, really depends on your time horizon. Anyone out there who is maybe new to investing or is consuming a bunch of investing content. I know that there's a ton of you out there that are, have been watching hours and hours of YouTube videos, consuming hundreds of hours of investing content online. I know because I did, and it's addicting, but it's exciting, and it can also be very confusing and overwhelming. If I can give you any advice to help you on your way when you're first starting, is ask the question, what am I investing for? What is my investment time horizon? I'm 33 years old. I'm 20. I'm 55. When do you plan on living off of your portfolio? When do you plan to transition from your active income, from your day job, to no longer working and then relying on your portfolio, your investments, to pay for your living expenses? That's your time horizon. So Dale, I'm going to make some assumptions. I'm just going to assume that you're going to retire at the age of 60, right? That's still retiring early, but you're retiring more at a traditional age. So we're assuming here about 30 years is your time horizon, because you also mentioned that you have a pension. So I'm assuming that you're probably going to work until your traditional retirement age. So when I'm looking at your portfolio, I'm going to assume that. So when looking at your portfolio here, you got the core and satellite. I love this. So you've been following my channel for a while. I always have been talking about the core and satellite. So you got two pies here. You got an income pie and you got a growth pie. This probably checks out well because if you have about a 30-year time horizon, you want more in growth. So let's take a look and see what's in your income slice. You got a large percentage in SCHD. You got Chevron, Altria Group, PNC, UPS, Texas Instruments, and QSR. So I do like the individual percentages. They're not more than 5% of your overall portfolio. The way that you would calculate this is you would just take the 0.07 times that by 0.30. So 2% of your overall portfolio is in these individual stocks. Now, with Chevron, it's a little bit more. You got 4%, but still below the 5%. So you're doing good in my book. Now, in my opinion, I think you need to add something with SCHD. SCHD alone is not going to give you a lot of market exposure. And so when the market's booming like it has been these last couple of years, you're going to dramatically underperform the overall market. So that's why I like combining SCHD with an ETF like DGRO. You don't have to do DGRO. It's the one that I like. You could do VIG, you could do DGRW, you could do, there's a whole bunch of other ones. I just personally like DGRO. And so I would recommend combining SCHD with another ETF so that you can get more growth potential, more market exposure, so that when you have major bull runs, you're not overly concentrated in such a small subset of the market. Let me explain what I mean by that. When you invest into SCHD, you're only getting about 6% weighted overlap with the US market. Okay. Now, given that the US stock market is overly indexed towards technology companies, NVIDIA, Microsoft, Apple, Google, for good reason, because they're market cap weighted, they represent a higher market cap in the index. But because you're only getting such a small percentage of the overall market, it's very likely that you're going to underperform in many years. And so I like to balance that by adding a more growth-focused dividend ETF like DGRO. So that's why I always say combine SHD with DGRO. And so let's take a look at your growth slice here. You got VUG, you got Google, Meta, Apple, Caterpillar, AbbVie, CVS, Waste Management, DraftKings, Bros, Dick's Sporting Goods, and Walmart. All really, really great companies, all very well allocated in terms of the target weighting. I like this. I don't mind this at all. And whether you go with VUG, SCHG, SPYG, those are my three favorite broad-based growth ETFs. I do have VGT. It's very, very concentrated in tech, but for just a more balanced portfolio, I like VUG, I like SPYG, SCHG. Those are some great ETFs. So when it comes to your portfolio, I really like this. And, by using the core and satellite, you can then rebalance your portfolio as you get closer to retirement. Now, when I say rebalance, it doesn't mean that you have to sell the individual positions, but let's say you invest into this for the next 10 years, and then in 10 years, maybe you lower the growth to 60 and you increase the income to 40, and the new money that you're investing gets allocated more towards the income portion of your portfolio. So treating this kind of like a target date fund is the way that I would go about this. Not a lot of people talk about target date funds and managing, DIYing your dividend portfolio like a target date fund. I'm the only one that I know that talks about this. And I think that this is a really great approach to how you can self-manage your dividend portfolio and treat it like your own personal target date fund. Now, it's easier when you have it with just ETFs. If you're using the core and satellite, I think that this approach can also work very, very well. So Dale, thank you so much for sending over your portfolio. I think you're in a really great spot. And I think if you just keep focusing on learning more about your investment time horizon, your goals, I think you're well on your way. Thank you so much for sending over your portfolio. The next portfolio is from Nick. He writes, "Hi, I'm 18 years old and recently started watching your channel. You've inspired me to pursue dividend investing as a way to be more financially liberated in the future. Below, I listed my current portfolio. It's only ETFs as I believe I don't have enough money yet to be going for individual stocks. At the moment, as young as I am, trying to invest into growth. So as I get more money, I plan to invest more specifically in my SCHG, SPYG. There you go. Good. We just talked about those positions. Additionally, I was thinking of adding we just talked about VGT, but I was wondering if some of my ETFs are too repetitive. Would love any advice on how I should structure my portfolio currently and how I should continue to invest in the future." So I promise I didn't read this in advance. So this guy probably follows my channel because these are all ETFs that I recommend. I am invested into SPYG for my son as well as VGT. I own VGT in my Roth IRA. It's one of my largest positions. I couple VGT with VTI and VXUS and VNQ in my Roth, 40% VGT, 40% VTI, and then 10% in the other two. Those three, SHG, SPYG, and VUG, I see them as interchangeable. I wouldn't invest in all three of them for an individual account. I would pick one of them. I wouldn't have all of them. Now, you can combine one of those three with VGT, and I think that that's absolutely fine. Yes, you will have overlap. Anytime you're getting a market cap weighted index, you're going to have overlap. The largest companies are bubbled to the top. They represent a higher percentage of these indices. It's just how it works, right? So just understand that. But I think it would be a little bit overkill to have all of them, right? VUG, all of them. So I would probably pick one of the three and then maybe VGT as well. But I like combining it with a total US stock market ETF like VTI, because then you're casting a wider net, you're getting more exposure. So that's my thoughts and opinions on that piece. All right, Nick, let's take a look at your portfolio here. So you got a handful of ETFs. I love the fact that you're first starting out and you're going only with ETFs. Now, you can invest into fractional shares. You could buy fractional shares of individual stocks, but I really like the fact that you're 18 years old and you're investing into such high quality ETFs. If I could snap my fingers and go back in time when I was 18 years old and do what you're doing at this level, it hurts my brain to think about how different my life would be financially, but that's life, right? I'm not gonna dwell on that too much because I'll just get sad and have to go eat some ice cream. When looking at your portfolio, I like the ETFs in here. You got DGRW. This is a growth ETF. It focuses more on future dividend growth versus historical growth. It looks at future metrics. I like that. SCHD, great dividend ETF. SCHG, great great growth ETF. SPYG, great growth ETF. VNQ, great real estate ETF if you want real estate exposure. VTI, also great. So here's my thoughts and opinions on this. Some things a little bit nitpicky with VNQ. This is a real estate ETF. This is a non-qualified dividend. Do you have a Roth IRA? In my opinion, I would put VNQ into a Roth IRA. You could always add VNQ later, right? Looking at this from the approach of a target date fund, right? Some of these ETFs you're going to hold forever, right? And they're going to compound and grow. Other ETFs, you're going to, I'm assuming, look to rebalance and reposition the portfolio in the future. The way that I think about this is, you've heard me say this before, I see my investments, my ETFs, like a real estate portfolio. Let me explain. I owned rental properties in the past, and when I think about my dividend portfolio, my dividend ETFs, SHD and DGRW as an example, also VNQ, these ETFs are like rental properties. The value of the home doesn't matter as much. What I'm interested in is the growing rental income. The idea is I'm never going to sell the shares or sell the rental property, and I'm just focused on the income and how that income is growing. That's the way that you kind of want to think about this. A portion of your portfolio is kind of like a rental property. You're going to set it and you're going to never sell it. At least, that's the intention. Things can always change. Now, the other portion of your portfolio, the growth part, SCHG, SPYG, and VTI, those are more like flips. Have you ever heard of house flipping, where you buy a house with the intention of maybe fixing it up and you're going to sell it? You bought the house for $100,000 back in easier times. And then in the future, years down the road, you're going to hope to sell that house for $200,000 for a nice, 100% gain. The purpose of that transaction was to make a gain on the purchase of that investment, whether it's a flip, real estate, for example, or in your individual, investments in the stock market. They serve the same purpose more or less. And so when you're thinking about your portfolio, think of your investments this way. Where are my rental properties and where are my flips? Which ETFs am I going to flip in the future? Which ETFs am I going to hold forever? And me personally, by thinking in that way, it helped me to understand and allocate, okay, these are my rentals, these are my flips. And that's how I've always looked at my dividend portfolio. My Roth IRA is an example, right? My Roth IRA is all about flipping. In my Roth IRA, I'm going to flip those investments into dividends ETFs in the future. My taxable brokerage, because I'm living off my portfolio today, if you know my story, it's all into JEPQ, SHD, DGRO, a little bit of JEPI. Those are my rental properties. I'm living off the income from those, right? And so you want to look at your portfolio and your strategy holistically across your taxable account, your retirement accounts, and see how you want to set this up. And there's no right or wrong, right? You could do, you could flip your investments in your Roth. You could do your rentals in your Roth, however you want to do it. There's no right or wrong because it depends on your personal time horizon. Does that make sense? That's how it works, right? So don't let anybody tell you that your way is right or wrong. It depends on your own personal situation. It's called personal finance for a reason, because it's personal to you. When it comes to your ETFs, I like all of these ETFs. Yes, you're going to get overlap into SPY, G, SCHG. I think that those are fine. You could add a little bit of VGT as well. What I would recommend you do is use a spreadsheet or use a target. So these are your current allocation. If you were doing this in Excel, I would have a separate column next to your current weighting and have a target weighting. What is your weighting now? And even better is you want to treat this like a target date fund. I don't want to repeat myself that what I said in a previous video, but I want to recommend that you go watch this video and you learn about how to build your own target date fund, with your dividend portfolio. And I will leave a link to that video at the end of this video. The video is called What I Wish I Would Have Known 20 Years Ago, kind of applicable to you, here, at 18 years old. But go and watch that video. Towards the end of the video, I walk through a very detailed example of how you could treat your own dividend portfolio like a target date fund and how you can self-manage it. But with this, Nick, I think you're off to an incredible start. You got a lot coming your way. You're going to change your mind a lot, and that's okay. Just try to understand which investments are your rentals and which investments are your flips. And when you kind of think about it that way, I don't know about you, but for me, it always helped to think about it in that way. So Nick, with that, I hope that this helps, or anyone in Nick's situation. I hope that this was helpful. And Nick, thank you so much for sending over your portfolio. All right, the last portfolio, I don't know the name of the person, but they wrote here, I will do my best to explain what I have in my portfolio in a second. First, a little bit about a background about me. I'm a male 28-year-old about to turn 29 in a couple weeks. I live with my parents and help support a good portion of bills like property taxes, utilities, and other expenses, along with my own expenses like insurance and other bills. So my expenses are manageable and I try to invest what I can. I'm single with a girlfriend, hoping to get married in the next few years. I love to have kids with her, but she's a few years older, in her mid-30s. So who knows what will happen? She doesn't have much saved, if anything, so it'd be mainly up to me for retirement. I'm saving as much as I can and estimating ballparking. I can throw account numbers in retirement calculators, but being young, there can be lots of variables, Social Security, pension accounts. So probably like 2 to 2.5 million. So my house is owned because my grandmother bought it and gifted it a while and wrote it off a few years ago as it was cheap. So that major expense should be taken care of. Just living costs, and hopefully me and my girlfriend wife someday can live cheaply in the rural part of Oregon, like 2 hours from Portland. I make like $26 an hour, about $54,000 a year, in a line worker at a factory. Will also have a pension program if I stay there a while. I'm just hitting a year there. Takes about 3 years minimum to be vested. I don't know the numbers besides $3 to $4 per working hour goes into the program. Sorry, I don't know anymore. No problem. I don't know how it works. I'll try to break down my portfolio besides the pension, Social Security I should have. I'm thinking about a 25 to 30 year time horizon. I want the option to slow down work and enjoy life in my mid to late 50s, sooner if financially available. But most of my money will be locked up until retirement age. Anything, please feel free to ask. So let's take a look at your portfolio here. So you break it down by different account type. So you got your current employer, your goal here is you're in your did you say your late 20s, I believe you said? I think you said that late. Yeah. So about 29 years old, and you want to retire in the next 25 to 30 years. So you have almost 3 decades before you're going to live off your portfolio. That's a good amount of time. And you're probably going to be after the age of 59 and a half or close to it. So maxing out your retirement accounts is always a good idea first, in my opinion. And then if you have money left over, then you could put money into a taxable account. Maxing out or focusing on your retirement accounts, 401k, Roth IRA, HSA, if your company offers it as an example, I think would always be a good idea to begin with. And as your goals in life change, you could always pivot. You could always change. Maybe you get injured at your job, or your goals change where you want to retire in your early 50s, right? There's many things that could happen. And so just keeping that in the back of your mind is never a bad idea. All right, so let's take a look at it. Your current employer 401k with the factory, about $1,400. You put about 6% every 2 weeks. You don't have a match because you'll have you're with a union with a pension. So you're contributing about $150 every 2 weeks. Okay, that's great. So it's unfortunately your company doesn't match it, but you're working for a union. So I think that's absolutely fine. Now, when I look at your investments, you got a whole bunch of stuff in here. You got the Dodge and Cox, the Vanguard Windsor, you got Fidelity 500, Vanguard Growth, Vanguard Midcap. When I see this, I see a lot of stress and I see a lot of anxiety when I see this. And I see myself 15 years ago. When I got my first corporate job and I had a 401k, this is kind of how I invested. I had a little bit in small cap, a little bit of mid cap, a little bit in growth, a little bit in international. I was paying huge fees. I was paying like 1%, 1.5% mutual fund fees for a lot of these. And I quickly learned that this is how Wall Street would like us to invest. This is how Wall Street wants us to think investing should be. That it's hard, that it's complex, that it has to be over-engineered. Once I stumbled across The Simple Path to Wealth by J.L. Collins, that this isn't how it has to be. You could invest in one ETF and you could accomplish all of your goals. Wall Street wants you to believe that you have to overcomplicate it. In my opinion, if this was my account in my situation, I would put 100% into the Fidelity 500, S&P 500 index, 100%, and I would call it a day. And in most cases, most likely, you're probably going to outperform with just going with the S&P 500. You're going to perform better on the fees. You're not going to be paying huge management fees, and you're probably not going to run into the illusion that you're going to think, oh, do I need 5% or 7% in this guaranteed institutional or international fund? Do I need 11% or 13% in the Windsor? Throw all that crap out the window. You can avoid all of that stress and anxiety with just going with the S&P 500. So in my opinion, I'd throw all the complexity out the door and I would keep it simple. And me personally, I would put everything 100% into the S&P 500. Now, if that's too simple for you, the way that I always used to think about this is that it's too simple, it has to be wrong. That if it's going to be good or right, it has to be complex. That was the illusion the myth that I believed years ago. And then once I realized that it was a bunch of BS and that I could accomplish all of my goals at a lower cost, lower expense ratio with just the S&P 500 or the total US stock market, if your employer offers it, your employer's plan, I would just recommend going with the S&P 500 and calling it a day. But that's just my personal opinion. Your former 401k, you got cash, and you got, with all of your 401ks, in my opinion, with everyone, this is how I did it for my wife and I, 100% into the S&P 500, or depending on your age, right? If you're 65 or you're in your 60s, I could see the case for having more of a value-focused fund. But someone who has 30 years, sticking with the S&P 500, in my opinion, is probably the way to go. You could look at some of these growth funds. Some of them may make sense, but in my opinion, I'm sticking with the S&P 500. I think it just is the easiest way to go. And then you got cash in here. You got a little bit in fixed income, maybe some bonds here. And then you have equities. I'm assuming your equities are in a taxable account. In your taxable account, you got a bunch of mutual funds. Maybe you're a follower of Dave Ramsey, or Dave Ramsey, maybe not. I know he advocates a lot for mutual funds. They're ridden with high fees. In my opinion, I would probably simplify this and look for an index version of this, try to lower the fees. I would look at, if you're focused on dividend ETFs, I always recommend SHD, DGRO. If you want growth ETFs, SHG, SPYG, VUG, as we talked about in this video earlier, or if you just want a total US stock market ETF like VTI or VOO, I would reevaluate these complex mutual funds with high fees. My gut tells me you're either watching Dave Ramsey, which is not a bad thing, right? Or your family is connected with a financial advisor and they're recommending similar investments. And in my opinion, I think you could, if you're looking to do this as a DIY investor, I would avoid mutual funds altogether. And I would focus on low fee, broad-based index funds. That's how I would do it. And your current Roth, you're putting about $150 a month into some similar ETFs, as I was advised, or something I believe. Yeah, you're probably talking to a financial advisor or your family or friend. And so that's why your portfolio looks the way that it does. And yeah, your portfolio looks like this because you're connected with a financial advisor. This is what financial advisors do, is they put you in these high fee mutual funds, and it's not for your benefit, it's for their benefit. They say it's your benefit, but the incentives are just upside down. The advisor is incentivized to put your money in his pockets. And that's why he's recommending similar type of, such type mutual funds. And I'm not a fan of it. I think, especially if you're watching YouTube and consuming investing content, I think you're smart. You probably, or you're interested, or you're curious. I think the word is curious. You're curious to see if there's another way, that your gut tells you that this is so complex. Does it have to be this complex? Well, your advisor or Wall Street would like to make you believe that it's complex so that they can put your money in their pockets. That's how it works. That's how it's always worked until recently. The information around investing is a little bit more widespread now. The gig's up. Everybody kind of knows that, the incentives of advisors are up, backwards, right? So, and then you got some more cash in here. So this is your Roth account. You got a bunch of mutual funds, and yeah, what I would recommend is for your Roth account, same as your equity account, low fee, broad-based ETFs. You don't have to go with individual stocks. So yeah, when I look at your situation here and I look at your goals, what I would do is I would recommend you kind of rethink everything that you've been told regarding your portfolio. Whether that's right or what I'm saying is right or whichever one's right or wrong, it doesn't matter. It doesn't have to be right or wrong. What I would recommend is what's right for you. And oftentimes, for the majority of people, the simple way is the way to go. What I would recommend you do, and anyone in your situation who's kind of confused or relying on a financial advisor, I highly recommend go take a look at the book, The Simple Path to Wealth by J.L. Collins. J.L. Collins, he's kind of the pioneer when it came to the FIRE movement. He didn't create the FIRE movement, but he's really a huge influence on the direction of the FIRE movement. And I would encourage you to go read that book. It's not dividend focused. It's not dividend focused at all, right? But it helps you to understand investing and your finances. And I would recommend you read that book. Now, what I talk about on my channel is entirely inspired by J.L. Collins' book, The Simple Path to Wealth. And I kind of drew inspiration from his approach and created my own, The Simple Path to Wealth with Dividend Investing, where I'm investing into low-fee, broad-based ETFs like SEHD and DGRO. And you're focused on your core portfolio around those ETFs or something similar. They're just examples. And then you build off from there. But what I think you need to do, and anyone in your situation, go read that book. Read his book, think about it, consider, your options, and then I would go back to the drawing board when it comes to your investments and see how you can simplify this. Because not always is more better. Oftentimes, and almost in every case, when it comes to investing, less and more. And this is counterintuitive to what your advisor is going to tell you and to what Wall Street would have you believe. Because what they want is they want to put your money in their pockets. And that's not in your best interest. So with that, everybody, I hope that this video was helpful. I hope that you learned something new. Thank you so much for watching, and I'll see everybody in next week's video.
Please subscribe. Please subscribe.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.